Well, I wanted to thank you guys again for coming and your interest in the subject matter. It's a tough subject on a nice sunny day outside in spring. So, like Josh said, I'm Robert Ingram. I'm a tax advisor, and I'm also an estate planning consultant for AFI Advisors. And hopefully you guys know that we provide those services to our clients. And in order to do that, we need to be aware of all the latest federal tax laws that are out there. And more than just that, we need to know more than the tax laws. We also need to know what debates are happening in Congress so that we can plan for potential outcomes that will happen because of that. Now, you may have heard in the news here lately discussion about child tax credit that may be adopted here before the end of the year. That's really small potatoes in comparison to the subject that we'll be talking about this afternoon, which is the sunsetting of certain provisions of the Tax Cuts and Jobs Act of 2017. So that was the largest tax reform legislation here recently, and it decreased tax rates across the board for all taxpayers. It decreased tax rates for corporations. It decreased tax rates for individual taxpayers. But unfortunately, in order to get around a filibuster in the Senate, the senators were forced to make the tax rate decreases for individual taxpayers temporary. And so we'll be seeing all of those tax rate cuts sunset at the end of 2025. So the tax rates for 2025 and 2026 are going to be different. And they will all, unless something is done by Congress in the meantime, they're all going to automatically increase. And that's just the way Washington works. They decided to set these up to sunset. And not only did they do it for tax rates for individuals, they also did it for other benefits of the tax reform. So you guys probably are familiar with not providing as much information about your itemized deductions to your tax professionals. That was due to the standard deduction increasing that came along with this reform as well. And there are also many other provisions. We provided a sheet in front of you from the Cato Institute. It's showing every single thing that will automatically change in 2026. And I'm just going to hit the highlights here. But one of the major temporary provisions is the qualified business income deduction. I know some of you are self-employed. Some of you have pass-through businesses where you get a Schedule K-1 from a partnership or an S corporation. Underneath this tax reform, you automatically had a 20% deduction for that business income. And that's going to be going away in 2026. Also, another thing that has to do with estate planning is the estate tax exemption. So in 2017, the estate tax exemption was around $5 million. You could transfer your estate without an estate tax if it was under $5 million. Well, with this tax reform, they increased it to over $10 million. And with the cost of living adjustment, they have been increasing since then. So it's up to $13.6 million right now that you can transfer totally tax-free through your estate.
Per person.
Per person, yeah. Exactly. So in 2026, if Congress doesn't intervene and pass something in the meantime, we're reverting back down to the 2017, and we're probably looking at a $7 million estate tax exemption. Now, The big deal with all of this tax reform is, according to the Congressional Budget Office, over 10 years, this was supposed to create, a deficit over this decade of $1.9 trillion. So the government is going to continue to spend more than it makes each year, and the debt is going to continue to grow. And with this reversion to 2026, we're likely to see the lowest income taxpayers bear the burden of the increase. So if we look at tax rate increases in 2026, the lowest tax bracket, it stays the same, but the next one, so it goes from 12% up to 15%, so that's a 3% increase in tax rates. The next tax bracket is 22 up to 25, and actually the maximum increase is for this particular tax bracket here, 24% up to 28%. So this 4% increase is the largest increase proportionally across all of the tax brackets. So if you're in this income segment, if you're single, or this one, if you're married filing jointly, you're bearing the burden of this tax rate increase. Now, this provides a problem for Congress. They're going to have a bunch of people that are upset from one year to the next. So they're discussing things that can be done here. Now, in addition to the tax rates that are increasing, we also have the standard deduction reverting back to where it was in 2017. So if you're a married couple filing jointly, in this year, your standard deduction is $27,700. It's going to drop to $12,700. And so on and so forth for single filers and heads of household. So there's going to be a major change here. Now, what's going to pop back up is personal exemptions. I don't know if you guys remember those. Like, you get a personal exemption for yourself and other members in your household. So this will come back in, and it'll be very similar to the standard deduction, but larger families are going to benefit a whole lot more than smaller families. So where everybody was advantaged with the standard deduction change, personal exemptions are going to come back in, and some will benefit and some will not. Now, the next point here is the state and local taxes. Now, people from high tax states like New York, Illinois, California, they sort of bore the brunt of the tax reform. And so there's going to be political pressure to keep this reversion back in place so that, if you're paying more in state income taxes, you're going to see bigger deductions on your income tax. So there's going to be a lot of tension between different groups within our society about what needs to happen to fix this jump up in tax rates. And so again, this qualified business income deduction, the 20% just for having small business income or pass-through income, that's automatically going away. And so there's going to be pressure from small business owners in order to have some sort of provision in place. And of course, this estate and gift tax exemption is going to be reverting back. Now, if nothing changes, the federal government is going to be collecting more revenue. And that would actually benefit paying down the debt that's ever increasing. So every year we're spending more than we're making. And debt service has actually become the third largest portion on the U.S. federal government budget. So we have Social Security, Medicare, and then debt service. And that's only going to increase over time. And so there's actually a political desire to maybe just keep things the way that they are so that the federal government is collecting more revenue. But of course, you're going to have Republicans that are talking about wanting to decrease tax rates. And then Democrats that are going to be talking about specific social programs that are benefited through the tax code. So there's going to be a lot of conflict back and forth. Either way we cut it, whether the Republicans win the election, whether the Democrats win the elections, what we've seen here recently is that there are slim majorities in Congress. And so that leads to gridlock. More likely than not much will happen. And so we'll probably see these changes, these automatic changes happen, and then only bits and pieces will change over time. So what does this mean from a tax planning perspective? So Roth IRA accounts are the best vehicle in this environment. And so I want to say that this is the most important thing that we can be doing. We need to be maximizing how much we contribute to Roths. And now is the opportunity to make Roth conversions. If we have traditional IRA accounts, we can distribute those funds and convert them into Roth accounts and pay the taxes now so that we won't pay the larger tax rates and the larger tax burden in the future. And so depending on what your situation is, how much your time horizon is, all of these strategies make a lot of sense in everybody's situations. Now, there are other qualified accounts, and these are just tax beneficial accounts like health savings accounts, 529 education accounts. There's a special wrinkle for 529 accounts where if you have this account for 15 years, you can convert it into a Roth, about $35,000 worth of it. So that would be great for yourself, for your spouse, for your dependents, and also for your grandchildren. These are great things that we can set up. And also because of what more than likely will happen with the estate and gift tax exemption, strategies for trusts and gift planning are going to be back in vogue. And so where back in the day, trusts were a very popular vehicle in order to deal with this, those are going to be popular once again. Now, Peter is going to then go on and talk about just general strategies regardless of what happens with these tax rate increases.
Yeah, and so to compound the estate planning problem, and this might be a little bit locally centric, we've seen, and everybody's seen it, property values increase. So that house that was valued at $200,000, if it's valued at $600,000 now, okay, does that $400,000 put us over a dropped limit or whatever it is? So kind of compounding things in a lot of different ways for the tax problems. And I will say with the 529 plans, you don't have to even intend to use them for college education. So if you have a 15-year time horizon, and the thought process would be, okay, I can put $6,000 in a Roth IRA. And I think it indexes up to 7 next year, or 65 this year, 7 next. And I've maxed out what I can do at work. What else can I do? For those people who still want to be putting money away, if you put it in a 529 plan, you could actually kind of go back and figure out, okay, if I had X amount in a 529 plan over a 15-year time period, what would get me close to $35,000? And you can contribute that way. And just like a health savings account can roll into a retirement account, the new rules on 529s allow it to roll into a Roth. So in theory, like I should open a 529 plan in my name with me being the beneficiary with no intention of it ever being used for college. It's just the logistics around doing it. I'm kind of tasked a little bit today with talking about the most common tax things that we talk to people about. And so I've got a list of 5. I'm going to kind of go through those quickly, and I can go more in depth if we need to, because I want to leave some time for questions. But these are things that we talk to people about on a daily and weekly basis that hopefully they'll apply to yourselves. So step-up basis is huge. And This is the should I title the house in the kid's name discussion, generally. So the way the current tax law works is assets in your name, when they are inherited, step up to the value on date of death. So if you had a stock that was worth $50,000 when you bought it, it's Apple and it's gone up to $100,000 and you pass away, your inheritor inherits at $100,000. So if they immediately sold it, they don't have to pay capital gains tax on that. So it saves them a certain amount. Same thing is true with houses, and this is particularly important in our neck of the woods, because how many people in our area have that family plot that, granddad got it in the Land Act and, put an $8,000 cabin on it, and then we've expanded it. And if they give it to their children pre-death and go through the titling process, and generally people are doing that because they want to avoid the probate process or anything else, then you're immediately giving them also your cost. So if they go and sell that, they pay the full brunt of that tax. So by waiting for it to step up, that's always kind of the better option there. And so, this is that same example on a home, $100,000 home that goes up to $500,000. You're saving potentially 15 to 20% on a $400,000 gain by not distributing that to your child early. One of the other things that we talk to people about is charitable gift strategies. And so these are kind of a hierarchy of the best ways to give. And so our area is very philanthropic in nature. And this is, in general, the best way to give. So if you have appreciated stock in a non-IRA, so that same Apple stock that's doubled in value, if you give it to the church or you give it to a booster club that's a 50c3 or whatever it is, they can sell it tax-free, and then you can rebuy it. So instead of giving them $5,000, give them $5,000 worth of appreciated stock and rebuy your stock if you like it. The next would be qualified distributions from an IRA. So once you hit RMD age and you're required to start putting money out, if you actually give that money from your IRA to the charity, that's tax-free for you. You don't pay the income tax on that distribution. So rather than taking a $5,000 distribution from your IRA and then writing a $5,000 check to the church, you just directly do it, and then you're not paying on that $5,000 worth of income. And we do that for a lot. Chastity's, I think, back there, we'll have lists, and it can be as little as $25, and it adds up. And each, based upon those brackets that Robert was talking about, functionally, if you're in the 25% bracket, you're saving 25% of every dollar that you do that way. And then the last would be cash and check. So always be charitable where you can, but there are better options in donating. So the appreciated stock is super important too, given where we've been at in the market. So since 2009, functionally we're a straight up market. We've had sell off in 2020. We had 2022 was a bad year, but the long-term gains on these stocks are pretty high. So that's one way of doing it. And then tax loss harvesting is another thing. All this basically means is if I've lost money over here and I've gained money over here, if I sell them in the same year, they can wipe each other out. And so what we'll do on our accounts is at the end of the year, we'll look at what the unrealized gains and what the realized gains are, and we'll try to offset that. That way you don't take individuals. And this chart really kind of shows it. So if we sold a stock with a $20,000 gain and you were in the 35% bracket, you'd owe $7,000 in taxes on that sale. If we then also had a $25,000 loss that we sold, we've wiped out that $7,000 in taxes. And then because we can apply $3,000 of loss to our income tax at the 35 bracket, we save another $1,050. And so that by pairing those two trades, we have potential tax saving of $8,050. And so when we're looking at it, especially with these long-term, items in taxable accounts, if we can offset in some way, not that I ever want to have a loss, right? But some of those losses can work in our favor. This one is that deductible? So this is going to become more and more important with what Robert was talking about as well. It's been a while since I've had to do an itemized, outside of someone with medical expenses that are in excess, it's been a while since I've done itemized tax return for Schedule A. But medical expenses, and this is the confusing one, it's above 7.5% of your income. So a lot of times we'll have people come in and say, well, I have $3,000 medical expense, but if they had $100,000 worth of income, not a single dollar of that goes into the calculation. So medical is tough. Taxes you paid, interest you paid for mortgages, your gifts to charity, not counting the ones out of your RMD, casualty and loss. But I find a lot of times people will say, and contractors are really bad about this, they'll say, well, this is tax deductible to you. It is if you can itemize type thing. But if you can't itemize, and that hasn't been true for a while, for a lot of people it hasn't. Now you do still have the home energy credits, but I would always check with whoever's doing your taxes when a contractor tells you that that's going to be tax deductible. And these are kind of the standard deduction rates now. So it's really hard for a lot of people to get above these amounts. And it will change when tax rates revert. And as interest rates went up and mortgage interest is heavier, now we're at that point where for a lot of people, we might be able to itemize again. So that used to be the thing. Well, if I'm paying $10,000 in mortgage interest, then I might have enough of these other deductions to worry about keeping track of. Whereas now, where it's tough to get there, we're going to be in that position of keeping track again. This is the last one on mine, and I'm not going to spend a whole lot of time, but it is something that we're looking at more and more. These are municipal bonds. So if you think about a CD at a bank that's paying you 5%, you get your 5%, but you have to pay taxes on that interest. If you buy a municipal bond, so that would be like the city of Kingsport issues out a bond that they are paying a lower tax rate or a lower interest rate to you, a lot of people would be like, well, why would I buy a 4% municipal bond when I could get a 5% CD? It's ultimately on your tax return. And so there's, depending upon what bracket you're in and where you're at, you could potentially be buying go back that way. So let's say we were in the 28% bracket. That 4%, municipal is actually the equivalent of 5.6% taxable. So you would have to get a CD paying you 5.6 or a Ford bond or whatever it would happen to be equivalent. So it's sometimes a little bit trickier there. From us, our perspective in investment portion is, if I present back out a portfolio to somebody of municipal bonds and the yield is 4, and then they come back and say, well, I can get 5% down at ECU. It's having that conversation of net, so yes, it's 4. It's the equivalent, though, of 5.6 because you're not paying taxes on it. But our performance is going to be worse. So if you just compared our statement January to December, our performance is worse. But by the time you account for what the government takes out from your checking account, it's better. So those are all little strategies that we do. And it's one of those things that it's going to become more and more important. And I think it's one of those things that the Roth conversions especially are going to be important, not only for the reasons of the tax rates coming up, but the new tax laws with inheritance. So when I inherited my IRA from my dad when he passed in 2019, the rules were different. So I have my lifetime, I have a calculation that I have to pull that money out over the course of my lifetime. If he had passed away 1 year later, I would have 10 years to take the entire amount out. And that will be, hopefully, at the peak of my earning period. So if it had come to me in a Roth, I still have to take it out in those 10 years, but I don't pay taxes on any of it. So every dollar that I'm taking out of my dad's IRA that I inherited is taxable income to me. But if I can stretch it over 35, 40 years, significantly better than 10. And so even if the Roth conversion doesn't move the needle for yourself, it might move it for the next generation. And it's one of those ones that we're starting to see more and more of that, especially with, we're about to go through the largest wealth transfer that we've ever seen as, you know, millennials and whatever gen names you want to call, you know, are inheriting. Now the question will be, do they inherit it or do the medical companies inherit it? And you know, it's less. But in theory, you know, the amount of wealth that's going to transfer, especially with property values and everything else, is going to be massive. So anything that we can do to eliminate some of those taxes, whether it's the estate planning with Robert or doing some of the Roth conversions, is super important.